Right now, the crypto market is at a moment where almost nobody can agree on what comes next. And that uncertainty is exactly why you need to be paying attention. Some analysts in the XRP space are warning that the price could fall all the way down to 70 or 80 cents by the summertime. Others are saying the opposite, predicting a rally back toward $3 or even $4. And then there are those who believe the entire financial system is about to shift into something completely new, where assets like XRP could play a much bigger role than most people realize. When you have predictions that far apart, it tells you one thing very clearly. The market is at a crossroads. And moments like this are where the biggest opportunities and the biggest mistakes usually happen. Welcome back to Bullion IQ, where we break down what's really happening in the world of finance, crypto, and global markets. If you follow this channel, you already know we try to cut through the noise and focus on the signals that actually matter. Right now, there's a lot going on in the crypto space, especially surrounding XRP regulation in the United States, and the broader macroeconomic environment that could influence where the market goes next. In today's discussion, we're going to break down the latest XRP chart analysis, new regulatory developments coming from U.S. agencies, the role of major financial institutions entering crypto, and why some analysts believe the market could still experience significant volatility before any major breakout happens. Let's begin with the technical side of the conversation because this is where many analysts are drawing their predictions from. Recently, XRP experienced a sharp correction, and when traders look at the chart, they are comparing it to what happened during the previous cycle back in 2021. At that time, XRP dropped roughly 74% during a major correction. But what happened after that drop is what makes this comparison interesting. After falling more than 70%, XRP didn't simply continue downward right away. Instead, it staged a powerful rally of around 170%. In other words, the market gave investors a huge bounce that made it look like the worst was over. But that rally turned out to be temporary. After that major bounce, the price eventually returned to similar lows again. The market created what traders call a lower high before continuing deeper into the bear market. That entire structure is something many analysts are watching closely today because the current price movement is starting to resemble that same pattern. What this means in simple terms is that even if XRP experiences a strong rally in the near term, it may not necessarily mean the bear market is finished. It could simply be a relief rally before another move lower. Some analysts are suggesting that XRP could bounce back toward levels around $2 or possibly even near the $2.40 area where a local high formed earlier in the year. But even if the price does reach that level again, it may still only represent a temporary recovery rather than the beginning of a new long-term bull run. In fact, some traders believe that kind of rally could actually trap buyers who assume the market has fully recovered. Another important technical detail involves the exponential moving averages, commonly known as EMAs. When analysts study price trends, these lines often act as areas where prices either find support or face rejection. In previous market cycles, XRP lost its position above key EMAs, rallied briefly back toward them, and then got rejected before continuing downward. Right now, the price is significantly extended away from those averages, which makes many analysts believe the market could attempt to move back toward them first. If that happens, it could create the appearance of a strong recovery. But for experienced traders, that move might simply be the market returning to a technical level before deciding its next direction. This is why some analysts are warning that the upcoming rally, if it happens, could actually be the move that pulls new buyers into the market just before another decline. At the same time, the broader sentiment across the crypto community has been shifting. If you look around social media, trading forums, and even YouTube comment sections, you can feel the fatigue building. Many investors are tired. The market has gone through months of uncertainty, mixed signals, and constant debates about whether we are entering a new bull cycle or still stuck inside a prolonged bear phase. What makes this even more complicated is the global economic environment. Many investors were hoping that central banks would begin lowering interest rates soon, making money cheaper and encouraging investment into risk assets like stocks and cryptocurrencies. Lower interest rates often increase liquidity in the financial system. And historically, that liquidity tends to push asset prices higher. But the reality is that the situation may not be that simple. Inflation remains a concern in many parts of the world. Unemployment data is starting to shift, and central banks are finding themselves trapped between controlling inflation and supporting economic growth. If rates remain higher for longer than expected, that could continue to put pressure on risk assets. So right now, the crypto market is balancing two very different forces. On one side, there are major developments happening behind the scenes involving regulation, institutional adoption, and new financial infrastructure being built around blockchain technology. On the other side, there is a challenging macroeconomic environment that could still create volatility across all markets, including crypto. This is why opinions are so divided right now. Some analysts believe the market has already been in a quiet bear phase for more than a year and that the next major rally could begin soon. Others believe the market still needs to go through one more painful correction before the next expansion phase begins. And when you look at the current XRP conversation, you can see that exact debate playing out in real time. Some analysts are preparing for a possible drop towards 70 or 80 cents, while others believe the foundation is being built for something much larger. When you look beyond the price chart and start examining what investors are actually doing with their XRP, the story becomes much more interesting. One of the latest data points circulating in the crypto analytics space shows that XRP's exchange deposit and withdrawal transaction delta has fallen to an all-time low. That might sound technical at first, but the meaning behind it is actually very important. This metric tracks the number of XRP transactions moving between major cryptocurrency exchanges and external wallets. In simple terms, it shows whether people are sending their tokens to exchanges to potentially sell them or withdrawing them to private wallets where they are more likely to hold them for the long term. The recent decline suggests that more investors are moving their XRP off exchanges and into external wallets. Historically, this behavior is often interpreted as a bullish signal. When investors plan to sell, they usually send their tokens to exchanges because that's where trading takes place. But when they move their assets into private wallets, it usually means they are preparing to hold those assets for a longer period of time. It represents a kind of flight to safety where investors prefer to maintain custody of their digital assets rather than leave them on trading platforms. This trend becomes even more interesting when you combine it with the broader developments happening around Ripple and the XRP ecosystem. A video recently resurfaced featuring Rosie Rios, the former U.S. Treasurer who currently sits on Ripple's board. Her comments gave a rare glimpse into how Ripple views its role within the global financial system. Rios explained that Ripple is deeply involved in building infrastructure for cross-border payments between financial institutions. That is the core function of XRP within the ecosystem. The goal is not simply to create another speculative digital asset, but to facilitate the movement of value between institutions across borders quickly and efficiently. According to Rios, Ripple's operations extend across several key regions, particularly throughout the Asia-Pacific market. The company has established partnerships and customers in places like Singapore, Japan, Korea, Hong Kong, and the Philippines. Institutions such as SBI in Japan, DBS in Singapore, HSBC in Hong Kong, and Union Bank in the Philippines are all connected to this expanding network. These partnerships highlight a strategy that Ripple has been pursuing for years, building relationships with financial institutions that handle large volumes of international payments. When you start looking at the broader picture, it becomes clear that Ripple's strategy has always been focused on infrastructure rather than hype. And the company has been positioning itself as a bridge between traditional banking systems and emerging digital payment technologies. If that vision continues to develop, XRP could play an important role as a settlement layer for international transactions. Another factor adding momentum to the conversation is the increasing focus on central bank digital currencies, often referred to as CBDCs. Around the world, central banks are experimenting with digital versions of their national currencies. Some of these projects are still in pilot stages, while others are moving closer to real-world implementation. What makes this relevant for XRP is the growing number of CBDC initiatives that involve companies like Ripple and major financial networks such as MasterCard. If CBDCs become widely adopted, they will require infrastructure capable of connecting different financial systems together. Cross-border payments are one of the biggest challenges that banks and governments face when implementing digital currencies. Ripple's technology was designed specifically to address that problem, which is why the company often appears in discussions surrounding global payment modernization. At the same time, there's been a major regulatory development in the United States that could reshape the entire crypto landscape. For years, one of the biggest challenges facing the crypto industry has been the lack of regulatory clarity. Different government agencies have often disagreed on how digital assets should be classified. The Securities and Exchange Commission has argued that many tokens should be treated as securities, while the Commodity Futures Trading Commission has suggested that some digital assets function more like commodities. That disagreement created confusion across the market. Companies didn't know which regulations applied to them. Investors worried about sudden enforcement actions, and trillions of dollars in potential institutional investment remained on the sidelines waiting for clearer rules. Now, there are signs that this long-running conflict between regulators may finally be easing. The SEC and the CFTC have entered into a memorandum of understanding that establishes a framework for cooperation between the two agencies. Instead of competing over jurisdiction, they will now coordinate their efforts, share data about market activity, and conduct joint examinations when necessary. This agreement could have enormous implications for the crypto industry. With clearer regulatory communication and coordinated oversight, the uncertainty that has held back institutional participation may begin to fade. Large financial institutions typically avoid markets that lack regulatory clarity because the legal risks are too high. But when those rules become more transparent, it opens the door for significant new capital to enter the space. And that possibility is one of the reasons many analysts remain optimistic about the long-term future of digital assets. Even though market sentiment feels weak right now, the structural developments happening behind the scenes are moving in a very different direction. Governments are building regulatory frameworks, financial institutions are integrating blockchain technology, and major payment networks are expanding their digital asset capabilities. At the same time, the broader economic environment continues to add uncertainty to the market. Rising oil prices, inflation concerns, and geopolitical tensions are all factors that could impact global financial markets. Historically, whenever oil prices spike dramatically, risk assets like stocks and cryptocurrencies tend to experience corrections shortly afterward. That pattern has repeated itself several times across previous market cycles. This is why some analysts believe a broader market correction could still be ahead. Bitcoin remains near historically high levels, and major stock indexes have not experienced the kind of deep correction that often follows major macroeconomic stress events. If traditional markets begin to decline, cryptocurrencies could feel the impact as well, at least in the short term. So once again, the crypto market finds itself pulled in two directions. On one side, the technological and institutional foundations of the industry are growing stronger. On the other side, macroeconomic pressures could still create volatility before the next major expansion phase begins. One thing becomes very clear. While the market price may feel stagnant or uncertain in the short term, the level of institutional activity behind the scenes keeps increasing. Large financial institutions are no longer just experimenting with blockchain technology. They are actively building products, launching funds, and preparing for a future where digital assets are integrated directly into the global financial system. One of the most recent developments highlighting this trend comes from BlackRock, the world's largest asset manager. BlackRock has launched a new product called the iShares Staked Ethereum Trust ETF, which recently began trading on the Nasdaq. This is significant because it combines two different elements that institutional investors have been waiting for. First, it offers direct exposure to Ethereum as a spot asset. Second, it allows investors to benefit from staking rewards, which means the fund can generate yield while holding the asset. For traditional investors who prefer regulated financial products rather than direct cryptocurrency ownership, this kind of structure is extremely attractive. It allows them to gain exposure to digital assets through familiar investment vehicles like exchange-rated funds. And that's exactly how the early stages of institutional adoption often begin. Institutions rarely rush into completely new markets all at once. Instead, they start by introducing structured products that gradually bridge the gap between traditional finance and emerging technology. This naturally leads to a question that many XRP investors are asking right now. If major asset managers are launching products around Bitcoin and Ethereum, when will they start doing the same for XRP? The idea of a future XRP ETF has been circulating in the crypto community for quite some time. While nothing has been officially announced yet, the environment is slowly shifting in a way that could eventually make that possibility more realistic. For years, many banks avoided engaging with digital assets because the regulatory risk was simply too high. Even if they believed the technology had potential, they did not want to expose themselves to legal uncertainty. But recently, executives from several major financial institutions have started describing a noticeable change in how regulators and banks are approaching the space. According to some industry insiders, the tone of conversations between banks and crypto companies shifted almost overnight after recent political developments and regulatory discussions. Institutions that once avoided the sector are now exploring partnerships, reserve banking arrangements, and transaction services tied to stable coins and blockchain-based payment systems. That kind of change may seem subtle on the surface, but inside the financial industry, it represents a major shift in mindset. Banks are not just curious about blockchain anymore. They are starting to prepare for a world where digital assets become part of everyday financial infrastructure. This is particularly relevant for companies like Ripple, which have spent years developing payment systems designed specifically for institutional use. Ripple's technology focuses heavily on cross-border payments, liquidity management, and transaction settlement between financial institutions. If large banks eventually decide to integrate blockchain-based payment rails into their operations, companies like Ripple could benefit significantly from that transition. XRP as the digital asset designed to facilitate liquidity within Ripple's network would naturally become part of that conversation. But again, these kinds of transformations rarely happen overnight. They develop gradually as regulations evolve, infrastructure improves, and financial institutions gain confidence in the new systems. While these long-term developments are promising, the market itself still contains risks and unexpected events that remind investors just how volatile the crypto space can be. A recent incident involving a massive decentralized finance transaction demonstrated exactly how quickly things can go wrong when dealing with large amounts of digital assets. In that situation, a trader attempted to swap $50 million worth of USDT for tokens using the official AY application. The interface displayed warnings about potential slippage due to the size of the transaction, meaning the price could change significantly during the trade. Despite those warnings, the trader confirmed the transaction. What happened next was a perfect example of how decentralized markets operate. Because the liquidity available for that trade was limited, the transaction executed at progressively worse prices as the order moved through the liquidity pool. By the time the swap finished, the trader had only received about $35,000 worth of tokens in return. In other words, nearly $49 million in value disappeared during the trade due to extreme slippage. The founders of Later responded by returning some of the transaction fees associated with the trade, which amounted to about $600,000. But even with that refund, the traders still experienced an enormous loss. Incidents like this highlight the importance of understanding how decentralized exchanges work, especially when dealing with large transactions. Unlike traditional financial markets where market makers provide deep liquidity, decentralized finance can sometimes experience severe price impacts when large trades are executed. Events like this remind the market that even though blockchain technology offers incredible opportunities, it also requires careful risk management and a deep understanding of how these systems operate. For newcomers to the space, the complexity of decentralized finance can be overwhelming, which is why education and awareness remain so important. Despite these risks, the overall trend continues moving toward deeper integration between crypto and traditional finance. Large institutions are building infrastructure, regulators are working toward clearer frameworks, and developers are expanding the capabilities of blockchain networks. These developments suggest that the foundation of the crypto ecosystem is becoming stronger, even if market prices don't always reflect that progress immediately. One of the most significant developments for crypto firms in the U.S. right now is the upcoming change in regulation from the Office of the Comptroller of the Currency, or OC. These new rules, which officially go live on April 1st, are being called a game changer for how digital asset companies can operate. Essentially, the OC has updated its chartering regulations to allow national trust banks to engage in non-fiduciary activities, which includes services like digital asset custody and related financial services. In simple terms, this means that certain crypto firms can now operate with the same regulatory authority that traditional banks enjoy, giving them the ability to hold customer deposits, issue stable coins, and provide broader financial services, all without needing a patchwork of state licenses. This shift represents a massive operational advantage for companies like Ripple, BitGo, Circle, Paxos, and Crypto.com, all of which have reportedly received national trust bank charters or conditional approval for them. These charters essentially put crypto firms on a level playing field with traditional banks, opening up opportunities that were previously off-limits. Instead of being restricted to limited operations, these companies can now fully integrate into the banking system, which could accelerate adoption and liquidity for digital assets like XRP. It's easy to see why this has caused some traditional banking giants like JP Morgan, Goldman Sachs, and American Express to push back, citing risks to consumers or financial stability. But the underlying reality is that these firms are now facing a shrinking competitive moat. Crypto companies can finally offer many services that were once reserved for the traditional banking sector, which directly challenges the old way of doing business. Adding to this, MasterCard has launched a new blockchain payments program in partnership with more than 85 companies, including Ripple, Circle, Paxos, PayPal, Gemini, and Binance. Through partnerships with banks such as WebBank and Cross River, MasterCard is enabling the development of global payment infrastructure that integrates crypto directly into everyday transactions. This isn't just theory or experimentation. This is the foundation of a truly global digital payment system. Ripple is positioned at the center of many of these efforts, which underscores the growing influence of its technology and XRP in facilitating international financial flows. When you combine the OC's regulatory updates with the expansion of institutional partnerships, it becomes clear that crypto is moving into a phase where operational capability and institutional integration may finally catch up with market speculation. For XRP holders, this could be particularly meaningful. While the price action might feel volatile or even stagnant in the short term, these regulatory and institutional foundations are what will determine long-term growth potential. It's the difference between hype-driven speculation and fundamental adoption. At the same time, it's important to recognize that the broader macroeconomic environment is far from simple. Rising oil prices, ongoing inflation concerns, and shifts in monetary policy continue to create uncertainty. Historical patterns show that spikes in oil prices often precede declines in risk assets, including both stocks and cryptocurrencies. This means that while infrastructure, partnerships, and regulatory clarity are improving, external pressures could still drive temporary corrections or volatility. Investors need to balance optimism about the long-term outlook with realism about short-term risks. Despite these challenges, the cumulative effect of institutional adoption, regulatory clarity, and expanding infrastructure could be very bullish for the crypto market once the broader economic environment stabilizes. Think of it this way. Institutions are building roads while regulators are clearing traffic rules. Once the traffic can move safely and efficiently, there is potential for a much faster and more significant flow of investment into digital assets. Another angle to consider is the rise of stablecoins and the role they play as a universal file format for money. In partnership with companies like Visa, these digital currencies allow people across Europe, the Americas, and Asia to hold a consistent digital format that can be used seamlessly across borders by integrating with APIs and creating card programs in multiple countries. Developers and financial institutions can offer truly global services, making previously underserved regions accessible to modern financial infrastructure. This is not just theoretical. It's a practical, scalable solution that has the potential to bring millions of people into the digital economy for the first time. All of this shows that the long-term story for crypto is not just about price speculation. It's about building infrastructure, enabling institutions, and creating accessible financial systems. XRP, with its focus on cross-border payments and liquidity facilitation, is positioned at the center of many of these developments. The next few months could be critical as regulatory changes take effect. Banks adapt to new opportunities and institutions begin rolling out products built on blockchain technology. Now that we've covered the technical trends, regulatory updates, and institutional developments, it's time to connect the dots and look at what all of this could mean for XRP and the broader crypto market. The key takeaway is that while short-term price movements may be volatile and uncertain, the underlying infrastructure and adoption trends are moving in a clear direction. For investors, understanding this distinction between immediate market noise and long-term structural growth is critical. On the price side, analysts continue to debate where XRP might go next. Some are warning that we could see levels as low as 70 to 80, especially if a relief rally fails to hold and macroeconomic pressures intensify. Others are more optimistic, pointing to potential rallies back toward $2 or higher if institutional adoption and regulatory clarity fuel increased market participation. The truth is that both scenarios are possible and they are not mutually exclusive. A temporary drop could happen before the next major bull cycle, which would align with historical patterns where XRP experienced large corrections followed by strong rallies, but only after the market digested these movements. Beyond price speculation, there are multiple indicators suggesting that the fundamentals for XRP are strengthening. The reduction in multi-exchange deposits and withdrawals signals that investors are increasingly moving their tokens into secure wallets, which usually means longer-term holding. At the same time, Ripple's growing network of institutional partnerships, especially across the Asia-Pacific region, highlights the company's strategy to become the backbone of global cross-border payments. With partnerships spanning Japan, Singapore, Korea, Hong Kong, and the Philippines, Ripple is positioning itself as a bridge between traditional financial institutions and emerging digital systems. This gives XRP a clear use case beyond mere speculation. Regulation is also improving in ways that could accelerate adoption. The OC's updated chartering rules allow crypto firms to operate more like traditional banks, offering custody, issuing stablecoins, and providing broader financial services. Combined with memoranda of understanding between the SEC and CFTC, the U.S. market is finally moving toward clarity. That clarity is crucial because trillions of dollars of potential institutional investment have been sitting on the sidelines for years, waiting for a well-defined framework. As the rules become clearer, more institutional money could flow into the market, bringing both liquidity and credibility to digital assets. Meanwhile, traditional financial giants are increasingly integrating crypto solutions. BlackRock's Ethereum staking ETF demonstrates the appetite of large asset managers for regulated crypto exposure. MasterCard and Visa are building payment infrastructure that supports digital assets globally, giving both individuals and businesses new ways to access financial services. Ripple is embedded within many of these initiatives, which could amplify its role in the future financial ecosystem. Even as these positive developments unfold, macroeconomic factors remain a balancing force. Rising oil prices, inflationary pressures, and central bank policies continue to introduce risk into all markets, including crypto. History shows that spikes in oil prices often precede corrections in risk assets, and cryptocurrencies are not immune. Investors should be aware that short-term volatility is likely, even if long-term trends remain bullish. It's a classic case of patience and preparation, understanding the environment, positioning appropriately, and not being swayed by short-term emotion.